Welcome you guys, everyone here today for our webinar on From Start to Scale, Leveraging SBA for Business Growth. And so great to have it presented by US Bank, our partner. And we have today here Ms. Delphine Pruitt, who is a Vice President of Business Access Advisor, and Ryan Johnson, Vice President of the SBA Division. So today it's a good opportunity to have a good discussion. They'll give us some insights, but also to you be able to ask questions. And like I said before, what I'm looking forward to as well is kind of learning some of the new things that's happening at the SBA regarding, I believe it's the 504 loans and 7A and stuff. So Ryan, you correct me, but there's been some updates and changes, and I believe that it's supposed to be for the better for people who are haven't had as much of a great opportunity in getting access to capital. So who will go first? Delphine, you want to take it away? You muted. Unmute.
Well, thanks. I'm having all these technical difficulties today and I can't even unmute. Good morning, and we're excited to be here today to share information on SBA. And what I wanted to just say a brief overview on what our community commitment and access program. And that's the program that I'm part of, Community Access. And I'm actually said access. Believe me, it's morning. My technology is crazy. So let me just take a minute and take a deep breath and relax. But our access commitment was created in February 2021 with a focus on decreasing the wealth gap. And we are leading with the Black community because they have the greatest gap between Black and white. So part of our engagement with Black Business Association and others is really to engage Black businesses who provide access to information, connection, and resources that would help their business grow and sustain their efforts. With that, we have been speaking with Sarah about our SBA program, and I'm going to defer now quickly because my computer, I can see it now on my end, blurring in and out. I'm going to introduce Ryan Johnson, who's with our SBA division, extremely knowledgeable. He's all thing, everything SBA. If I have an SBA question, if someone come to me, I immediately contact Ryan. He's been in business a long time. He'll tell you a little bit about his background, but it looked like my connection is about to go. So I'm going to turn it over to Ryan. Thank you.
Thank you, Delphine. Thank you. Oh, please go ahead.
Go ahead. Go ahead. Mm-hmm.
Well, thank you, Sarah. Thanks everyone for having me on today. Very excited to speak to everyone. So my name is Ryan. I am an SBA loan officer with US Bank. And so that means all that I do every day is SBA. I've personally been with US Bank for 13 years. And so I've been around for a while. If you're not familiar with US Bank, it's probably at this point hard not to be familiar with us, especially with recently the acquisition of Union Bank. Our footprint and presence, especially in the California market, is just getting bigger. With banks, sometimes have a bad reputation and sometimes rightfully so, but US Bank, we've been named 2022 most ethical, one of the most ethical companies, and that's for our 8th year running. And so I think people like me and people like Delphine, we come to work every day, to try to keep that streak going. So, so I'm here to talk about the SBA program. I'm a big believer in it. I was in business banking. So I helped people with apartments and their businesses and investors. And it was business banking, SBA, that I found the most, fulfillment in, because, helping businesses grow, helping people grow their businesses, take an idea and see it become a full-fledged business, hire people, help the economy grow, and just take ownership of their, future and trajectory, I think is an amazing thing. And so the SBA program, what is it? It is a form of government loan. I kind of call it the FHA equivalent in business lending. So if FHA loan, is a type of government loan for residential, SBA would be kind of the same thing on business. So the SBA, it's a government agency. It's similar to HUD, Department of Defense, all those types of agencies. But it provides a guarantee to banks. It says, hey, bank, go out, lend money to small businesses, help them grow, and we're going to guarantee those loans up to a certain percentage. Usually it's 85% guaranteed. And so that then, I guess, incentivizes banks to, and I'm just, I'm the loan officer, I'm a cog in the wheel, but we're just kind of going over big picture here. That incentivizes banks to go out, do these types of loans that they may not normally do. So Sarah mentioned there's the 7A and then there's the 504. And they're both equally advantageous. There's pros and cons to each. 7A loan is going to be the more, diverse program. You can do more things with it. You can use it to buy property, but since we're talking about advancing your business, leveraging SBA to grow your business, I'd say 7A loan would probably be the program to focus on, because that's the program you're going to be able to do those things with the most. So with a 7A loan, a lot of people think of SBA when it comes to buying property, but there's a lot of other things you can do with it. You can finance equipment through an SBA loan. You can get working capital and expansion for your business through an SBA loan. Let's say you have a partner and either you want out or they want out, or there's some sort of agreement. You can do a partner buyout. What I'm seeing, with rates rising as they have been over the last 12, 18 months, I've seen changes in, what's coming across my desk. 18 months ago, when rates were super low, it was a lot of real estate. Now, I'm kind of surprised to see it's a lot of business acquisitions. A lot of people are deciding to either they have a regular job, maybe they work for a company, and they have a background in a certain type of industry or business. They're choosing to acquire a business in that same arena and getting into entrepreneurship, business ownership that way. That is done through a 7A loan. But also, let's say you're running a business and you want to grow, but maybe I'd say a way to do that is to pick a lane that you kind of want to explore. And just like when you were probably starting off, you do some research, you make some investments, and you do your research to make sure you're kind of going in the right direction, but you're not quite sure. You're testing the market. Well, another way is to buy another existing business and bolt it on to your existing business, and you have a proven concept, you have a proven idea, existing clients. And so with business acquisitions, I'm a huge fan of them. I'm a huge advocate of them because with minimal down payment, that's subjective and it's relative, minimum down payment, but with a down payment, you can buy an entire business and either grow your existing company or become an entrepreneur through that process. That is done through a 7A loan. And then just to kind of finish the thought with all the things you can do with the 7A program, you can also do debt consolidation. Conversation I had with a they did like fabrication of different products, and they had a line of credit, they had equipment loans that they had used to grow their business. And so they're kind of making, you know, it was 8 to 10 different payments a month all over the place, all these different things. And, you know, some were credit cards, some were lines of credit, equipment. Well, the SBA, through a 7A loan, you can pay off all of those things, put it into one bucket, into one loan, and you can amortize that over 10 years. So like a credit card, you make the payments, you may or may not ever pay that thing off. It's just revolving. An equipment loan, if you go out to buy a CNC or some other type of equipment, typically it's going to be a 5-year loan. Within an SBA loan, usually we're looking at a 10-year loan. So the payments are spread out over a longer period of time, and that's going to lower your payment and improve your company's cash flow. With that, you can either, you know, decide to put those funds into further growing or investing in it in another way, or you can continue to pay down your debt. You just have more options. So in that specific situation, they were making payments of about $7,000 a month to, like I said, between 8 to 10 different payments. And with this consolidation, their payments were going down to $3,500. So it's that longer period for a growing business, you know, can be a great thing. So 7A loan is great when we're having the conversation of growing your business, using SBA, leveraging it to grow your business. And then just so we can kind of cover both bases, there's also the 504 loan. 504 is typically used to finance real estate. And that, I'm not sure if we want to cover the differences in financing real estate with the 7A and the 504. There's a lot of moving parts to each, but essentially the reason you might go with a 504 loan, because you can also do that with a 7A loan, is depending on the amount, depending on factors, kind of just trying to be general, but and if there's, you know, any specific questions, can answer those. But in general, sometimes the fees are a little bit better on a 504. Sometimes the terms and rates can be a little bit better, but then there's some prepayment fee considerations on the 504. So anyways, what I'd recommend is, let's say you're buying a piece of property or anything really, you want to find a loan officer that A, you know, you trust, B, that you can get a hold of and, you know, get a good sense of that you're in good hands. Because I always kind of say that in SBA lending, as a SBA loan officer, and even with the SBA program, it's not a commodity. Who you work with does matter, getting you the information that you need. And whether it's myself or anyone else at US Bank, I think we do a great job of providing information, providing options, and answering questions for our clients and prospects and whoever else. So that's kind of a higher overview of the program. I know you mentioned in the beginning about some changes. And so some of it we're still learning about. So, you know, some of it's kind of, we've been told it's happening, but it hasn't quite become official yet it's not like trickled down to us yet. But a big change that I think we're very excited about is, so going back to business acquisitions, usually you were only able to, through an SBA loan, acquire or sell 100% of your company. So if I want to buy a local bakery, I have to buy 100% of that bakery. And that's an SBA rule. If I wanted to buy less, it's just not an option. I can't at least get an SBA loan for it. That has now changed. The SBA is opening it up, and so that you can finance the buy-in for a lower percentage. We see that a lot. Looking back on my banking career, I've seen that a lot with like dentists and in the medical space. Usually you have maybe an older dentist or vet or something like that who wants to sell maybe half of their practice to a younger up and coming professional, and then over time that person would then buy out the second portion. And US Bank has a separate specialized program for medical, but in SBA that was never an option. Like I said, you had to buy 100% because it was set by the SBA. Now, or at least we've been told, it's not official yet, that is opening up so that you can do partial buy-ins. So that's going to be a big change to the opportunities for people who are looking to buy in to an existing business. We don't have all of the details because, and I have a lot of questions myself on what that's going to look like. But that's something that I believe from an SBA standpoint may already be in effect, but it does take lenders time to kind of process that and kind of implement it. So that's coming. And then this is more of kind of like getting into the weeds of an SBA loan, but let's say we have an individual who owns multiple companies, or their company is closely associated with another company. So that we would call that relationship potentially an affiliate relationship. And so in the past, if you owned a business and you were in, so there, an affiliate would be another business that you own, or it could also be a business that has significant control over your business. And so what that would maybe look like is, let's say you had a business that really only had one customer. You had a big contract with one customer. It potentially could be called an affiliate relationship. And so that bigger customer could, from the SBA standpoint, need to somehow be involved. It sometimes would get really messy and complicated, and it was just kind of very confusing. It was something that sometimes required multiple conversations with credit officers, and there's a lot of moving parts. The SBA has simplified that. They made it a lot simpler. And again, we're still getting the details, but my understanding is if our borrower owns 50% or more of another business, that is an affiliate. If you don't, then it's not an affiliate. And so for someone who's just learning about SBA loans, that may be a groundbreaking or big thing, or it may not even make sense. But for existing businesses who maybe have multiple types of businesses or different relationships, it's going to make getting an SBA loan easier. So I would point out that is something new. And then this is something that I think existing business owners or people who are just learning about SBA for the first time, I think will appreciate and easy to kind of understand is there's an SBA guarantee fee. And that's something that goes directly to the SBA. It doesn't go to the lender, and it's universal. So if you talk to 10 lenders, they should all give you an estimate of your SBA guarantee fees that are the same. Because again, it goes to the SBA. The SBA, again, is a government agency. It's unique in that its operations are not financed through tax dollars like other government entities are. It's financed through these guarantee fees. So anyways, this fee, the tiers that determine how much of a fee you pay is the SBA lets us know each year what the different tiers are, and they kind of make adjustments. Like as an example, during COVID, for a period, there were no SBA guarantee fees, and that was really nice. But now that things have kind of gotten back to normal or normal-ish, where they've started to put those SBA fees back in place. Well, loans at $500,000 or less, there are no guarantee fees. Whereas it used to be there was a guarantee fee on every SBA loan. So that's kind of a nice that's a nice bonus. And even with SBA fees, typically we can finance those into your loan and include that as a part of what's being financed. So for example, on a loan of 600,000, I have this at the top of my head because I quoted it out yesterday, but there was a loan for, no, it was 550,000. So right above the threshold. This SBA fee this year on a 7A loan is about $2,900. And that's something we can finance. But that person, they're buying an existing business that's generating, I think it was like $75,000 a year in income, and there's depreciation and all other good things that came with it. And so going back to, asking questions, when you speak to someone about an SBA loan, maybe asking something to the effect of, hey, what should I be asking you? What should I know? Because in that conversation yesterday, I pointed out to that client, I said, hey, just so you know, you can avoid an SBA guarantee fee if you lower the loan amount to $500,000. Now in that case, their loan amount was $550. So putting in an extra $50K to avoid a $3,000 fee doesn't quite make sense, but at least they know what their options are, so I think that's important. And then you can make whatever decision is best for you. And then the only other thing that I think might be good to know or just be aware of is the SBA, when it comes to non-real estate. So again, if the topic of this call is to go over leveraging SBA to grow your business, any SBA loan that is used for anything else other than financing real estate. So if you're not buying a piece of property and you're getting an SBA loan, that falls in the bucket of non-real estate. And the SBA rule on non-real estate is if the borrower owns real estate, so if you own your home or you own an investment property or anything like that, then the lender, whoever the lender is, so it's universal, we have to take any equity that's available as collateral for that non-real estate loan. So you could be getting a debt consolidation loan and it's unsecured debt. It's a line of credit. Maybe it was an equipment loan, so that collateral is that. But if you own real estate and you're doing a debt consolidation, we have to take a lien against real estate equity you have to secure that loan. Now, if you don't own real estate, or maybe you don't have enough equity to cover your full loan, that's okay. That's called a shortfall of collateral. And sometimes, very often we're able to work around that. But if you have it, we have to take it. But at loan amounts of $350,000 or below, that rule doesn't apply. So at a loan amount of $350,000, we don't, and you own a home, you own real estate, we don't have to take a lien against that equity. So if you're refinancing $375,000, you might consider, lowering the request by that amount, so that way we don't have to take a lien against the real estate. So that's something else I would point out, depending on the loan request, just to make sure that you're aware of the options. I feel like I'm just getting a lot of information. I just want to pause and see if I'm going in the right direction, if there's anything else.
Yeah, Delphine has put in slides and stuff, and I think it's some stuff that she would like for you to point out.
Yeah.
Delphine, you can take it over.
Yeah.
Okay, yeah, Ryan, I pulled up some slides from a former presentation we did, sort of like to go over a little bit about, I don't know if you can see the screen. Can everyone see it as I'm sharing? If you can kind of read some of these slides, I think it'll give us a little more background, because I want to know about U.S. Bank is about SBA preferred lender and what that means. So I'm just gonna pull up some slides, and when you finish, I'll advance to the next one. I got like about 3 slides. I think it'll help us a little more detail.
So that what we just went over was kind of a bigger overview of the SBA program. Now, there are differences between lenders, and so U.S. Bank's program, we'll talk about that. U.S. Bank is a preferred lender. And so what that means is, so again, it's all about this guarantee that the government gives to the lender on the loan. That is very important to every lender. And so when we're reviewing an application, we're reviewing it against the SBA guidelines on what we need to do to protect that guarantee. Now, as a preferred lender, that's a status symbol. That's a level that the SBA has given to U.S. Bank to say, hey, U.S. Bank, and then, well, let me take a step back. So the lender cares about the guarantee, but also it's expensive. It creates a whole bunch of issues if there's a lender out there giving SBA loans out that don't meet the criteria the SBA has set forth. So the guarantee is important to the lender, but also that the lender is doing things the right way is also important to the SBA. So this preferred lender status, what it says is that the SBA knows U.S. Bank. We've been doing it for long enough. U.S. Bank's been doing SBA loans for over 40 years, that you could think of it as like a rubber stamp. The SBA has said, hey, U.S. Bank, we trust you. We know you know our guidelines. And so when you are presented an SBA application and you confirm that the criteria is met, you can go ahead in-house and approve that SBA loan and essentially promise our guarantee on that loan. Now, that's not just given out willy-nilly. That is something that, and as a loan officer, I'm a cog in this wheel, but I know that it's not something that the SBA gives out easily. And so that is something you always want to look for when working with an SBA lender. If you were working with a non-preferred SBA lender, how that would then work is they would underwrite it in-house and say, hey, we feel pretty good about this, but again, we can't approve this in-house. They would then take your application, ship it off to the SBA, and then the SBA would need to go through it themselves and then confirm. So you're looking at, more time and just not as an efficient process. And then also, then a lender not being a preferred lender may also mean that, they may have a bad track record with the SBA. There's a reason why they don't have that status. Let's see. So yeah, in-house underwriting, we have dedicated SBA underwriters. We have dedicated SBA relationship managers. So another big thing is what's called a portfolio lender. U.S. Bank is a portfolio lender. And so I'm sure probably there's a good amount of people who are familiar with that term. That just means when we do a loan, we're keeping it on our books. You're not going to get a letter in the mail 60 days later to say, hey, U.S. Bank just sold your loan. Here's your new servicer. We manage that book ourselves. And there is a big market for these SBA loans. A lot of lenders, they'll do these loans, they'll package them up either themselves or between a couple different lenders, and they'll sell that to investors. So it's just like mortgages, we heard about in 08 and 09, and the same thing happens with SBA loans. But U.S. Bank is a portfolio lender. To me, that also shows that how we feel about the loans that we do and the confidence that we have, because once you sell that loan, you're kind of, wiping your hands a little bit from that. U.S. Bank keeps everything in-house. So once you get an SBA loan with U.S. Bank, you're assigned a relationship manager. That's a dedicated banker. Your loan officer is always around still, but you have a dedicated person that you can go to with questions. Hey, you need a statement, you need this, you need that. You have a dedicated person. And U.S. Bank has SBA relationship managers. So that just kind of further shows the investment, U.S. Bank takes SBA lending very, very seriously, whereas some lenders is kind of like a side dish, something that they kind of do, but it's not really their main thing. At U.S. Bank, SBA is a huge focus. And let's see, you know, I wanted to touch on construction because I'm getting, especially in the last 12 months, I've been getting a good amount of construction requests. You know, business owners are smart, right? I mean, to run a business, to start a business, to hire employees, there's a million things. Business owners are probably the smartest people you'll ever speak to. And so with the real estate market in Southern California, you know, it's hard, you know, property prices and everything like that. And so I've gotten a lot of requests from business owners who are saying, hey, I want to maybe build my own property. I found this land out here and, you know, it's within my distance. I want to build. That's something you can do with an SBA loan. And just like in a real estate purchase with an SBA loan, we'll finance 90%. On a construction loan, we'll finance 90%. I will say for a construction loan, you know, it's not for the weak of heart. Not to discourage anyone from doing it. It's just that, you know, you're dealing with contractors, you're getting quotes, you're getting bids, you're dealing with the city, you're getting permits, there's so many different things. But for someone who's got the stomach for that, it's a great program. It's something that, you know, I can think of without really thinking about it. I have 3 ground up construction, you know, requests approved that I'm working with. So it's definitely something that we do. I'm just going to kind of hit on some of these. So recapitalize, you know, if, I mean, recapitalize, that could mean a couple different things. You know, you started your business, you've proven the concept, and now, you know, you kind of put your own money into it, and now you want to recapitalize that. We do have working capital options, but that also could mean debt consolidation, like we talked about, refinancing, you know, different debt that you've taken on. Restructure, that again goes to that extended amortization, lowering your payment, improving cash flow, and then retain. Yeah, so that's the whole thing that SBA is about. You can buy a property, put 20% down, 30%, or you can get an SBA loan, put 10% down, and save that additional capital for, you know, either other projects, some other, you know, avenue in your business. SBA gives you more options. Let's see here. And another big selling point of U.S. banks SBA. So going back to the fact that SBA loans are typically packaged up and sold to investors, the only way an investor that can happen is if the SBA loan is on a variable term. So all SBA loans that are sold are on a variable term. But U.S. Bank, being a portfolio lender, we don't care about that. So we offer fixed pricing. So if you buy a piece of real estate, we can do a full 25-year fixed. If you're buying a business, we can do a 10-year fixed. Now, going back to the loan officer you work with, the conversation I'm having right now with my clients is, hey, what is your personal, you know, belief in where rates are going to go in the next 3 to 5 years? Because if you personally believe that rates are going to go down in the next 3 years, then maybe locking your rate for 10 years isn't the best move. I've kind of stopped giving people my opinion because, you know, it's personal. So it's what you personally believe. Some people are going to be a little more conservative and say, hey, you know, we'll worry about that when that time comes. Just lock my rate for the full term. Others are going to say, hey, I get that, you know, a benefit of U.S. Bank is a fixed term, but I want a variable because I believe rates are going to go down sooner. It's just whatever it is. But U.S. Bank, again, we give you options. You have fixed pricing. You know, multiple purposes in one project. That's a good point. You know, if you wanted to do, here's another example. Debt consolidation for a manufacturer. They really want to buy land to construct their own property, but in collecting their financials, inputting everything, the ratios just weren't where we needed them to be. But I noticed that their debt schedule, which is it just lists all of their business debts, was pretty long. And so I played around with that, and I figured out that by consolidating those debts, we would have their payment, and that extra cash flow that we now would save them could go towards the property. And so now they're able to buy that land and do that construction loan. So that's an example of addressing multiple purposes with one project. And, you know, in this day and age, something that's probably important for a lot of people is in an SBA loan, there's never a balloon payment. So once you qualify, you never have to refinance if you don't want to. 7A loans, you know, and a lot of this really, it's not super important to remember. You can, but you know, the max loan amount on a 7A loan is $5 million. And then with a 504 loan, you can go to higher amounts. You know, there's people out there, a lot of business owners who got EIDL loans, and that's an SBA loan. So you can only have a maximum loan amount in SBA of $5 million. So on a 7A loan, you're working with the lender you work with, and we're giving you the loan. So you can get a maximum loan of $5 million. On a 504, it's different because the lender you're working with is only doing 50%. So we're doing $2.5 million, and then the remaining 40%, because you're putting 10% down, is lent to you by a CDC, which is a different organization. It's closely associated to the SBA, but it doesn't count to your exposure. So that's how you can get bigger SBA loans. But when you peel back, so you may have heard in the past, oh, I got a 504 loan for $12 million as an example. Yeah, that happened. We do that. But when you peel back the onion and you look at the SBA amount, it's $5 million. That's the max you can go. So whenever I mention that, usually it may come up, well, I have an EIDL loan. That's an SBA loan. Does that count? No, that does not count towards this maximum $5 million loan amount.
You know, with some of this,
Here.
Ryan, I'm sorry,
Yep.
some of this you might have talked, so feel free when I pull the slide up, to just highlight it and say next slide, because I wasn't able to get it
Okay.
up. Okay, so you know, just feel
Yeah.
free to tell me to, you know, go advance.
Yeah, I think we covered really all of this.
Okay.
And if anybody has any
Um,
questions, raise your hand, let us know.
Yeah, something maybe on this slide that is good to point out. So I mentioned non-real estate. Anything that's not the purchase of real estate falls under the umbrella in SBA of non-real estate. And so non-real estate loan is on a 10-year amortization. So if you're buying a business, if you're doing debt consolidation, if you're buying equipment, whatever it is, and you're getting an SBA loan, it's going to be a 10-year term, 10-year amortization. On some equipment, we could potentially stretch it out even longer. That's specific to equipment, but just as a general rule of thumb, it's 10 years. Now, we're going to also piggyback on another point, which was you can use an SBA loan for multiple uses. So let's say you were buying a business and you were buying real estate at the same time, or you were buying a building, as I mentioned earlier, and doing debt consolidation at the same time. How does that change things? Does anything change there? Yes. This is another, and it surprises me, I guess, because this is what I do every day, but there's a lot of people who don't know this. Even, you know, if you're out there buying a property, if you're out there buying a business, you're dealing with brokers. Brokers are very knowledgeable because this is their business. So it behooves them to know, you know, financing options for their customers. But a lot of people don't know this either, that you can, when you're combining real estate with any other purpose, as long as the real estate is 51% or greater of the total loan amount, then everything gets amortized over 25 years, not 10 and then 25. So you're buying a business, a loan, 10 years. That's how long you have to repay it. And that's how your payments are going to be calculated based on 10 years. But if you're buying a business and it comes with the real estate, we'll amortize everything over 25 years. So quick example, I'm financing a medical spa, and they're selling the business and they're selling the real estate. And so by buying the real estate with the spa and amortizing everything over 25 years, the difference in payment on just the business, because if they had bought the business, it was 10 years. The difference in payment basically is the payment for the real estate, if that makes sense. So they're basically making the same, okay, let me slow down. If you just bought the business, in this example, if you just bought the business and you paid that loan over 10 years, so that monthly payment, and then the lease expense, because if you don't own it, you got to pay rent, that versus buying both the real estate and the business together and amortizing everything 25 years, those are the same. The monthly payments were the same. So that one, you're buying another asset, you're buying the real estate for the same thing as if you had just bought the property. Now you have to have the down payment for the real estate too. So, there is some other considerations, but if you have that down payment, then that's it makes 100% sense. So that's an example of how SBA loans, you can use it in different ways. And Delphine, if we could go to the next slide. Yeah, again, I mean, some of this stuff, we'll go over, but, you don't have to memorize it. I think if you just go back to the key point of whoever you work with, you feel good about, you feel like they're giving you options, then I think you will always be okay. There's some prepayment penalties, so you never have to refinance an SBA loan. There's no balloon. But let's say you get an SBA loan today and rates go down, in 5 years. And I want to refinance. What happens? On a 7A loan, there's no prepayment penalty after 3 years, so you'd be able to do that. On a 504, it's a little more complicated. You have 2 loans. There's different prepay languages for both. So just, I guess it's important to sit and think about, where not only, I guess where you think the economy or the market's going, but also where you think your business is going. You need a plan, because, does it make sense if, let's say the 504 has a 10-year prepay, one half of the loan does, it has a 10-year prepay. The 7A has 3 years. So, but the 504, the rate may be 25 bips better. So is that 25 bips today worth more than the flexibility to refinance if rates come down 1 or 2% in 3 years? These are the things that you got to consider. And again, it goes back to working with the loan officer that gives you kind of, the different options, so you're aware. Next slide, please.
Yeah, when we only got like 2 left, so you can go.
Okay. On non-real estate, and if you're leaving this call with, just kind of like the pillars, big points, like knowing non-real estate and real estate, that I think will help. 7A loan, knowing that that's going to be your loan for non-real estate loans. And then, looking for a preferred lender and a portfolio lender on non-real estate loans. So debt consolidation, business acquisitions, all those things that we already talked about. Any loan, any SBA loan with an amortization of less than 15 years has no prepayment penalty. So you can pay it off at any time without penalty if it's less than 15 years. So and that's going to always, a non-real estate loan is always going to be less than 15 years. So if it's non-real estate, you don't have to worry about a prepay. You have to consider prepay languages when you're buying mainly real estate. And And then there was something here I saw that I wanted to, no prepayment penalties. Okay, maybe it'll come back to me. If we can go to the next slide here. Yeah. And that, okay, and I'm looking here. Yeah, I think we pretty much covered all of this. Financing. Yeah, so there are lines of credit available through the SBA. Typically, it's $350,000. That's the line amount. It does base it. That's the highest limit amount, and so there are lower limit amounts that we provide. It depends on several factors, and 3-year revolving 7-year term. So that is actually changed. So that's another change. So had you gotten an SBA line of credit in the past, it would have been a 7-year product. It revolved for 3 years and then it termed out for 4. That has now changed. It's a 10-year product and it revolves for, I believe it's now 6 years, and then it terms out for 4. So it's 10 years in total. If you do any exporting, then that amount goes up to $500,000. And lines of credit are not available, though it's important to note, are not available for what's considered cash businesses. So, you know, a coin laundromat, a restaurant. These are businesses that are not eligible for lines of credit. The line of credit for SBA purposes is used to help bridge the gap on receivables. So you could think of it that way. If a business doesn't normally have receivables as a normal part of its business, then it would not be eligible for a line of credit.
I noticed that the 7A is the one that allows for working capital, but the 504 does not, right? So,
yes,
yeah,
that's right. And that goes back to non-real estate. Working capital would fall under that bucket. And so you would use the 7A program for that. That's good to point out that SBA loans are for-profit businesses. And so, you know, if it's a nonprofit, unfortunately, it doesn't qualify for SBA lending. U.S. Bank specifically does do some nonprofit. I've done loans for churches for their properties. And so, but generally speaking, 2 points. SBA is for profit, and then U.S. Bank does have some nonprofit options, but it's not through the SBA. And then any owner of 20% or more of a business has to be a full guarantor. And so if the company has 5 owners and 3 own 20% and 2 don't, they own a smaller amount, those 2 don't have to be on the loan necessarily, but the 3 that own 20% or more do. And then that final bullet point talks about what we already went over. You can combine real estate to lengthen the term of the loan. And if we can go to the next slide.
Question.
Yeah.
Did we have any questions? Okay.
I'm gonna stop sharing and give it back to you, Sarah.
Okay. Wonderful. All right. Well, I mean, it's a lot of wonderful, great information. I guess people are tuning in here, is just taking it in. Don't have any kind of questions to name for. I've already kind of inquired about mine. The main thing is just that trying to make it so that have a bit more ease of access regarding these loans and opportunities, and then also knowing that U.S. Bank is a preferred lender, so that working with U.S. Bank, you have greater, better opportunities with having your loan process.
And
Delphine, was there anything that
yeah, I
you?
was just gonna add that these are the SBA product lines now. If you, we are commercial lenders, so we do offer other products, just general lines of credit, equipment financing, of things of those nature. So we do have other products outside of SBA. So just keep that as an option. And our equipment financing, those are quick. You know,
Yeah,
see
right.
people get decisions, in a day, and 2 days
Mhm.
later, they're driving off the lot with a van or a truck
Oh,
that needs
boy.
their business. Those are real. I mean, I've actually worked with some clients that
Mhm.
during COVID needed a van because they was doing mobile, and they
Yeah.
came, to get refinanced, and she was kind of shocked that she got a decision the same day. So,
Well, and those are the kind of opportunities and stuff where we're in the title of what we're talking about here, from startup to scale, that, being able to act upon it as quickly as that helps businesses in that scaling process. So that's good.
yeah, but an SBA can really help you scale that jump, because what you talked about was the terms and the loan limits are far higher than you're going to get
Mhm.
on the
Mhm.
typical equipment financing, lines of credit, the other line.
Okay. Well, we're gonna be looking to make sure that we're keeping within the time, which we have 6 minutes left. So we're doing so great. Ryan, you are just a wealth of knowledge, and we thank you for joining us today to give us the rundown on everything. And Delphine, thank you so much for making this opportunity available. We love partnering with US Bank and look forward to doing more things together. For everybody else on the call too, please stay in touch with the BBA at bbala.org, and also know that, oh, thank you, Ryan, put this information in the chat. But also know that we have a certification workshop coming up on June 21st. It's a two-part series. You can find out information on the website. We want businesses to be certified for these contracting opportunities, which also means that it involves maybe getting bridge gap loans or something like that. So it all works together. I will give you guys back the rest of your day with 5 minutes to spare. And thank you so much for joining us today. Thank you so much, Delphine and
Right.
Ryan.
Thank you.
All right.
Thank you. Thank you, Zon.
Bye-bye.